I don't know, I think I know a few of you. I'd like to get to know, or actually talk to just a few of you and see where you're at in your business. Is that working? Okay. So Lyndon Hansen, I know him from college, CPA, business owner, investor. I'm a realtor, have been for 10 years. Business owner as far as real estate goes. Head of commercial real estate in Utah for Everest, Century 21 Everest, and was also part of FIG, the Fourplex Investment Group, and a few different things in Boise and Utah. But let's go around the room. Tobin, we've met. I like you. You're cool. Tell us about you.
I gotcha. Well, let's see. I've got my license 3 years ago. Mostly was doing primarily residential. Just got into the commercial division here in Ontario, so
nice.
Learning the commercial aspect. Work in land and development.
Land and development. Any investment as well, or?
For myself, yeah, working
in the commercial field.
Yeah, actually got a property that I'm trying to size up out in New Mexico. So
whoa,
I got some conversation to have.
We have a partner
with a new friend out there.
Yeah, for sure.
Yeah, so just keep coming to these things, keep getting new ideas, and just kind of keep going with them and playing with them and having fun with it and learning.
Cool, awesome, thank you. Next.
I'm Steve Gazzetti. I am a realtor at Ontario and Los Gatos. Been in real estate for as a licensed realtor for about 13 years. Prior to that, I was in the high-tech industry, and prior to that, I was a contractor. So I've been an investor throughout my life. I've also developed homes, built 2 spec house developments in the valley here over the years. I'm also in the commercial division as well. I specialize in multifamily, going into some leasing and retail space now as well. So kind of anxious to meet everybody and hear about the presentation and see what this is all about. So,
awesome.
Yeah.
Steve, I can foresee us being best friends in the future.
Okay.
Anybody that specializes in multifamily, I think I send Grace, I don't know, 4, 5, 6 referral checks every year, and I just sent her a client back, and so yeah, I love working with California realtors, especially people that understand the space and already work in multifamily. So
good.
Awesome.
Sounds good.
Hi, I'm Diana. I actually work at the Ontario Los Gatos office with Tobin, Steve, and Grace.
Awesome.
I have been in the office, or been a real estate agent for 1 year. Prior to that, I have 24 years of property management experience.
Wow.
She's a property manager,
We also
yeah.
could be friends.
She is very experienced in property management,
Cool.
yes.
And so you made it through your first year in real estate, as far as sales goes.
Yeah, almost 1 year.
Very good. What is it, 80% fail in their first year? So
She made it.
Free, yeah. Awesome.
Hi, my name is George, and I'm a California real estate investor. I had a few single-family real estate investment in the past in the west part of country, Seattle, Las Vegas. Now I'm trying to get into the multifamily area investment. So I was browsing for fourplexes and duplexes online, and I was trying to find a good agent to represent me in the Salt Lake City. So I go on to biggerpockets.com and found Sam's profile there. So I just called Sam, hey, I really want to talk to you, and can we get in touch? And so Sam helped me find a very good fourplex in Salt Lake City in the Lehigh area.
Nice.
Yeah.
Better, I want Lehigh.
Yeah, it's a good one. Yeah, it's a very fast growing area. Yeah.
Hi everyone, I'm Marie. I'm friends with George, and he invited me to come to this event, and just want to explore something and or something, like just want to see how it's going.
Welcome.
Well,
Welcome, Marie.
Thank you.
Hey everyone, I'm Danny Gould. I also am a realtor here at Intero, and I don't know, Facebook must have some sort of like, they must be listening to me because I saw Grace's post last night on Facebook, and I don't see many of her posts, but I've been researching syndication a lot for about the last year. And it's definitely something that I'd like to get into myself, being a syndicator. So I'm really curious to hear how it's done by the pros. I've done the bigger pockets thing. I've done all that stuff. But yeah, Facebook must be listening to me, Grace.
Oh, they listen for sure.
Oh, they,
Hey,
I know they do. I know.
it's
What do
the
you want
law
for
of
dinner?
attraction.
Start seeing-
I really want Pokey for dinner.
There you go.
It's the law of attraction. Attract it.
There you go. Helped by Facebook and Google, right? Listen.
Hey everyone, my name's John. I'm just getting started in real estate investing. I know Grace through, well, she was my realtor a couple years ago buying my house. And she mentioned to me at the time her involvement and interest in real estate investing. And since I, recently started getting interested, I figured I'd reach out. I work in an agricultural investment company, and so it's kind of similar, but definitely a lot to learn. I've also been trying to learn a little bit about syndications last couple months, so eager to learn something today.
Awesome. Very cool.
Hi, I'm Teresa. I'm here because my lovely and awesome sister Grace invited me, and I've
That's my sister.
having
Oh.
conversation with her and learn all the excitement about her work.
She's the smart one in the family, so I got her here to look at all the numbers.
She must be really smart because Grace is pretty smart.
Yeah. No pressure with you. Yeah, so I'm here excited to hear about new and excited opportunities.
Very cool. Awesome. Thanks for coming.
My name is Linda. I've been a licensed realtor for over 25 years and worked in property management, construction, and real estate for the same. I've owned some investment properties, and I've been really looking into the syndication in the past year. So I was curious to see what you have to share on that.
Cool. Exciting.
I'm Jackie, and Lynn and I work together. We've been probably working together for about 25 years.
That's so cool. Awesome.
Real estate development, property management,
Yeah.
real estate. Linda's great about getting out there and really doing the more personal real estate and selling the developments that we're building.
Cool.
And at this point, I think Linda and I have been really talking about trying to get into different opportunities, maybe outside the state and looking a little bit more on the personal. And we're both investors in multifamily in California, but it's really nice to see.
Yeah, we have some
outside.
partnerships in multifamily now.
Yeah.
We would like to get into more.
Awesome.
So,
Cool.
thanks for inviting us.
So really quick, I'm curious, where did you guys invest? Or what have you invested in?
Well, properties that we've built.
Sunnyvale and
Sunnyvale.
Redwood City.
Okay.
We
Awesome.
look too expensive
Cupertino.
here, we wanna go out of state where it's,
Yeah.
Get a little bit higher
Santa
cash flow
Clara.
maybe.
Yes.
Cool.
Yeah, a little bit more cash flow, a little easier on the pocket.
There you go. There you go. Awesome.
My name is Lyndon. I actually grew up in Fresno, but I haven't lived in California for a while now. It's been almost 15 years. I just sold, we opened some trampoline parks in Albuquerque, New Mexico. We just sold out of those because competition was too fierce and it's getting annoying. Bought some properties with Sam, and we got talking, I don't remember how long ago, and so we partnered up and looking forward to doing some fun stuff together.
Nari.
Yeah, so my name is Nari. Good afternoon, everybody. So I think I'm the oldest as far as the chronology calendar age goes, but real estate wise, I think several of you are much older than me. So I just got out of the tech industry, been there for quite a while, and started investing into more of real estate lending. People who want to go ahead and build a lot, right? So I've been investing with them more as a series fund and so on. want to take a look at this syndication. I was new to that from several other people. I think Sam's, I'm just coming for the second time here, thanks to Grace, right? Whom I ran into because she was just selling the house couple doors down.
Couple doors down.
I went in, took a look at it. She had done a very good job of presenting and so on the property, so it was pretty fast. Right? And so I said, no, so when she called, I said, let me just come. There is some opportunity to do it.
Glad you're here.
Thank you.
Good to see you.
So wait, what did you do in tech? I'm curious.
Oh, I work for a semiconductor industry, more in hardware development. So if any of you is using anything electronic, iPhone, iPad, etc., well, the machines that make the chips, we build the machine, design, build, service, whatever, right? So
You work with Micron at all?
Micron, boys, visited them. They are one of our big customers on the memory space. That's right, and they're doing good on the stock side.
Yeah, not too bad.
Yeah.
Okay, I'm just fixing one thing here. Yeah, so Micron is adding onto their campus in Boise a $200 million expansion right now. I'm sure you already knew that. But.
Yeah.
So we have Anita. Do you want to introduce yourself?
Sure. My name's Anita. I'm not a realtor. I am here with my son Nick. We both have a passion for real estate, and I want to get him started because he and I have been looking for an investment opportunity, and it's too expensive here in the area, so we're here.
Cool. Awesome. Was that everyone?
And that's Helen. Hi, Helen. Hi.
Helen! I'm Sam. Talk on the phone.
Yes.
Good to meet you.
We're introducing
Who are
ourselves.
you and,
Yeah.
and what are you doing
Oh.
in real estate?
Okay, I'm Helen. Actually, I'm searching for opportunities in, what is that, Salt Lake City, investment properties.
Awesome.
Too specific.
Yeah. So George introduced me to Helen, and she's selling a property with Grace, and
It's coming on the market this week.
yeah,
Yes.
somebody buy
So
it.
free up her capital to buy in Salt Lake City.
Exactly. This is me and George. Was that 2 weeks ago?
Yeah.
So these are the type of fourplexes he bought. You can't see it because we're standing in front of it, but the view is pretty awesome. But this is in a really, really good location. He bought, I think, really, really well. Right after he went under contract, they jumped. They owned one next door as well. The sellers did, and they raised their price. I think was it 40,000 or more?
Yeah, 47.
About 40,000, yeah. So he got a good buy. This is a 90s vintage, so it needs some work. George and me and the property manager were working together. It's being re-roofed right now. I think most of the tenants had storage in the dishwashers. They weren't actually using the dishwashers. But no, that really good example of an awesome buy in the Silicon Slopes area in Utah. We're here to talk about syndication, but I do everything. So Grant Cardone, is anybody listening to Grant Cardone, Uncle G? Does that call him? Okay, awesome. So he says, oh, hey, we're just on the time management portion of this seminar. Awesome, just kidding. He couldn't control it. Robert, this is Robert Ritzenthaler.
Hey guys.
Hello.
Hi, Robert.
Sorry I'm late.
No, it's,
Always fun trying to
you should
figure
have
out
told the pilot to fly faster.
rental cars. Yeah, that's true. That's true.
Come on up here.
There's this chair over there.
So no, George made an awesome purchase, and I was going to kill some time since Robert was a little bit delayed because of his flight and rental car.
It's a good thing there are cops on the highway, because I was going about 85.
Yeah.
Everybody tries 85 here, right?
Yeah.
That's normal.
That's the slow lane.
It's
getting hotter.
So really quick, we're going to go into syndication. Robert's going to talk about really what it is. I wanted to talk about why I got into syndication, because for me it's bigger than just making money. The reason I got into syndication is I was building fourplexes with a company for almost 4 years. I sold a lot to our mutual clients. Grace bought a few, I bought a few. And I really started looking at where prices were going. And it's kind of crazy. Grace, when she started talking to me about the fourplexes, we were asking about 600, and she waited and was doing research in other markets. She called me back. We were at 650, then we were at 700,000 for a fourplex, and now yours is actually just on the market right now. She's selling one of hers to go into some better properties. $929, I think we listed it at. So
Yep.
it's pretty good for, and it was just built, just completed. So anyways, I've had hundreds of clients buy these fourplexes and different properties from me. And I took a step back. I backed out of that company last year, almost a year ago exactly. And I said, I'm not sure this is absolutely the highest and best use of my clients' dollars, their hard-earned money that they're investing, my money as well, because I believe in the product. And so Grant, the reason I brought Grant Cardone up is he says, never buy anything under 16 units. You're stupid, dumb, don't do it. I disagree. And I agree. If you can get to 16 units, 20 units, or invest with Robert and Linda and I and Grace and go to 200 units. But you also have to start somewhere. So Grace and I are buying townhomes together, fourplexes. At the end of the day, I think what you'll take away from Robert and Lyndon and I and Grace is we're very, very, very conservative. If you feel like someone is pitching you and it's too good to be true, and they're being ultra aggressive, and everything has to go perfectly or maybe better than perfect, it's probably not the right investment. And that's the opposite of what we look for. So Robert, how many deals are you in between where you make an LOI? Are you about 100 to 150 analyzed deals?
Probably close to 200.
200 now.
Yeah.
It's growing because the market's hotter, right?
It's tough.
Yeah, it's a tough market. Lyndon and I spend hours and hours and hours going through these properties until we're even comfortable writing an LOI, and we're going through hundreds. Same thing with the townhomes and the fourplexes. I've noticed Grace really does her homework, and I love that. I hate it when an investor says, here's my money, here, just, yeah, whatever you say, let's buy it. And it's like, oh, well, I'm a realtor, I like commissions, but I have bigger goals for me, long-term goals. I have a foreign exchange student that I sponsored, that I paid for to go to school and paid for his $5,000 in dental work last year, and this is my niece and nephew. I'm saving for college funds for them, and my wife and I going to Bora Bora and saving for a retirement. So I have some serious long-term goals. My kids as well, that you saw on the first slide, they each have a townhome now that's going to be paid off by the time they're 18. And when they're 18, or before they're 18, they get to manage it, and it's going to be theirs, and that's how they pay for school. So when we're talking about syndication, the conclusion I came to is it's much lower risk for my investors. I'm going to be selling real estate for the next 20, 30 years. What do I want to sell to my investors? What do I want to feel good at the end of the day that my investors have put their money into? And it's syndication. Non-recourse debt versus recourse debt, economies of scale, and the ability to grow much faster, grow the portfolio much faster in a lower risk environment. So Robert's going to talk about that. That's really what I wanted to talk about. Every time I work with an investor, this is what we go over. Cap rate's really good. We want to have a high cap rate. But a high cap rate in Peru, Indiana is, our mutual friend was talking to me about it, and it was a killer deal as far as cap rate goes. It was high cash flow. But number one, I have no idea where Peru, Indiana is. And I also want appreciation in a market that's going to grow. So those Midwest, those high cap rates, maybe they're good, but they might not be the better property to buy. The best property in my mind is a high growth market, low risk, lots of job growth, and a quality asset that's going to have appreciation and cash flow. That's what George bought. That's what Grace and I have purchased, fourplexes and townhomes. That's what Lyndon has purchased. Robert and I and Lyndon worked on a deal together in Dallas earlier this year, 208 doors, very low risk, amazing location. I think we both just giggled when we were talking to investors about it, like, yeah, the owner operator didn't even open the pool for 2 years, and he took out covered parking, and he doesn't even have an apartments.com account, so he does no marketing. So sometimes you find a deal like that, and when you find that, it feels really, really good, because I don't get nervous for my clients when we invest in a deal like that. They're just, it's low risk. Now, obviously, our attorneys are going to tell us, don't say that, and everything has risk. but comparatively to a home or a duplex or a fourplex, these larger deals are so much easier to mitigate your risk and have economies of scale. And that's really why we are excited to work with Robert and have a team built with him. When I got out of my business last year, I researched the top syndicators in the country, who was the best at what they did and who was the most conservative, because we could be at the top of the market. And I know a lot of syndicators, and Robert, I think, is one of the best you could ever talk to as far as experience, conservatism, and very aggressive in his business models and planning with these properties. So, with that said, Robert, the floor is yours.
Awesome.
Do you need
Yeah, I was gonna say, if I can plug in there, that might work out pretty well. If I can pull up my,
Beautiful.
although I don't have Wi-Fi, but let's see, whatever. I don't need to have
Grace.
this. I can just.
There's a.
Is there a code? Okay.
There's a.
I can
I'll give it a
try to connect you.
I found a visitor one and guess one of those.
There's a password.
Do we have a hard stop at 8 o'clock?
Because
everybody has to leave at 8.
do a
Hold
really
this for
short
me, I'll go get
presentation.
them.
Okay. I bet you're gonna have a bunch of questions.
Well, that's what I was gonna say. I wanted to leave time for questions.
Yeah.
I'd love to get to know you guys a little bit as well. So I'll try to keep it brief. In fact, you know what, I'm not even gonna pull the presentation up. But first of all, thank you, Sam and Lyndon, for getting me over here. I don't know who opened up the office here, but appreciate you guys for.
Grace.
It was Grace, okay.
Yes.
Oh, very cool. And I've talked with you on the phone.
Yes, we
So,
have.
good to meet you finally in person. But it's good to be here. Greetings from Tampa, sunny Tampa, Florida. Made it here. And actually, it's funny because I was standing in the line at the rental car place, and there's 2 people in front of me. So I thought, oh, this is going to be easy. There's only 2 people. And then, of course, it's like 20 minutes for the first person, 20 minutes for the second person. And I'm looking at my watch thinking, yeah, this isn't going to work. And, of course, I'm sure you guys are the same way when you do something that you really love. So I love multifamily real estate. I was just thinking, I wonder how this applies to business. And it's kind of one of the things that we see a lot in our business, and you guys are probably familiar with this too, but one of the things we see a lot is people that get into the business and it looks really easy, and we even have a whole coaching and training platform where we basically, we're teaching people how to get into business. But there's certain things that just take years of experience to understand. And it's funny how even I'll get into a deal and I'll make decisions and I'll do things that people look at me like, how did you know that? I don't know, 20 years of experience, I guess. So it's kind of funny how I see that a lot, and that's another reason why we try to put together good partnerships, because it allows us to then reach out to a larger group of folks, give them opportunities to invest, have some good quality investments. But kind of going back to what Sam was saying, I think one of the most interesting things that I've found, and I've talked to, probably thousands of investors over the years, but one common theme has always stuck out to me. The more money that people have, the more they're focused on our team. Who are we? What kind of experience do we have? What have we done? And they're less interested in the deal. It's kind of fascinating. And I think they've learned, I don't know if it's the chicken or the egg, I don't know if they learned or maybe they just have always been that way, but I find it's opposite when you get to people that, they got their last $50,000 and they call you up and say, hey, I saw you got a good return on this deal, I want to get in. And I say, okay, well, so how much do you have to invest? I got $50,000, okay, what else do you have? Well, that's all I got just enough. And of course I have to nicely say, well, I can't take your money, I'm not going to do that. So it is kind of interesting, going back to what you were saying about how I've found that the really successful investors are really focused on the competency as well as the character of the sponsors or syndicates, whatever you want to call us. I mean, you say syndicator. It's kind of a relatively new term. As many of you guys know that the Jobs Act back in 2012 pretty much opened this whole platform, if you will, for people. So it's kind of changed. I mean, I would just consider myself a real estate investor, owner, investor, manager, operator, whatever you want to call it. So it's been kind of different. But anyway, so a couple of sidetracks since you brought it up. Just to give you guys a little bit of background on myself, I am originally started in the construction business. Actually, I worked for my dad when I was a kid. He built custom homes in Dallas, great market. And so grew up from 7 years old, I think, sweeping floors, and then kind of grew from there. So I can build a house with my eyes closed, which comes in handy when it comes to these multifamily projects. It's really nice to be able to walk in there and kind of see exactly what needs to get done. And then I moved to New York City, and that's where I started professionally in real estate. And so that's been close to 20 years now that I've been doing that. Got together with a couple of guys in the beginning, really good guys, and really learned most of what I know from them. Of course, New York City is a fun market. I like to call it like one of the big sandboxes, you know, San Francisco, Chicago, these really good markets. But we did everything from multifamily to office to, you know, we'd take an old office building, we'd gut it, and we turn it into lofts. We did condo development, value add, all kinds of stuff. And it was all right in that New York City area. So there's lots to do, and it was a lot of fun. But the great thing about it is that it was a small team. When I joined them, we had about 500 million under management. When I left, we were probably at about $1.5 billion. So, you know, enough scale to where you could do stuff. And again, I know that sounds like a lot, but you guys are from California, so you understand $1.5 billion in Tampa is probably like half the city. $1.5 billion in New York City is a couple buildings. I mean, it wasn't a couple buildings. You know what I'm saying? It sounds like a lot, but I mean, it was enough that there was a lot to do. But anyway, so we had our own in-house construction company, which actually I kind of helped start because the guys who were partners were attorneys. They didn't know anything about construction. So it was a great opportunity to kind of get that side of the business. We made an extra $3-4 million a year just doing construction once we got that up and running, so that was fun. But we always had our own property management company, and you know, we could talk about that. Well, we don't have time tonight, but there's a whole philosophy on when to use a property management company, third party, when to use your own, kind of some nuances there. Right now, we use exclusively third party property managers because we're in the acquisition mode, and we've got stuff all over the country. So we find good partners in these markets where we are. We get to know them. They're really like they're on our team, but we utilize them. But property management is important to understand because even if you've got a third-party property manager, you need to know what they're thinking, what they're doing, and sometimes I drive them crazy because I know what's going on before they even know because they're less experienced. You know, the district manager, they may be at it for 2 or 3 years, and you know, I'll say, hey, have you checked with the leasing person and asked about how they're selling this particular piece of their process? And I'm like, how the heck do you know that? I was like, well, I'm just looking at the numbers, and I think that's probably what's happening. Of course, they go back and, you know, they kind of retrain them. I'm sure you guys have all been through that. Like, what's the process? How do you sell it? Anyway, so the property management's really something that's important to know about as well. But I think, again, kind of going back to what I was saying about the experience, the one thing that's the most important when it comes to looking for an investment is the experience of that person running the deal. And I really encourage everybody, no matter who they're invested with, to take the time to talk with them on the phone, to meet them in person. We have these live events where we have 500-600 people that come. I always say, hey, come on out, check us out, see what you think. I think you guys were in Denver, right? Yeah. So, I mean, we had talked before. But again, it's just the more ability that you can see that person and get to know them, I think it's really important because you can understand who they are. Because anybody can throw out a good deal, or at least what looks to be a good deal. And that's a whole nother like 8 hours of conversation of underwriting, all that, which obviously we won't get into, but that's something else that is another reason why it's so important to know the people that you're working with. So that's just a little bit about my background, some of the things that I've done. I don't know how much Sam might have mentioned, but we are kind of all over the country. Now we're kind of expanding out to the West Coast with you guys. I spent most of my career on the eastern half of the U.S., all the way from Chicago, Dallas, New York, Miami, that whole area. My grandparents are actually from Berkeley, so I used to fly out there a lot and visit them, which is a lot of fun. But haven't done a whole lot of work on the real estate space. But it's the same no matter where you are. The market dynamics are very similar. So we're in a lot of different markets. We generally focus on the larger properties for the most part. And that's not necessarily because, again, going back to what Sam was saying, it's not necessarily because you can't make money in a smaller property. It's just that we like the scale of a larger property, and we feel like it's a little bit more diverse because you've got 200 or 300 units as opposed to, you know, owning one. So there's some benefits, downsides. Again, there's different philosophies on how to invest and when to do what size projects, and there's a whole kind of thinking that goes behind that. But we generally do the larger projects, and you know, it's tough right now. There's a lot that's pushing the market because of demand, both from the supply side, meaning people that want to invest, as well as people that need to find homes, and so you've got pricing constantly going up, which is good. You have market rents going up, but you've also got pricing that kind of is outpacing that to some degree. So it makes the returns a little bit more challenging. But I think that, again, it kind of comes back to the experience, and that's what I always push is make sure that you take the time to really understand. If you're doing a project or if you're working with somebody else, take the time to really understand who they are, what they know, and you know, vet them so that you feel comfortable with it. So,
Or what kind of questions should they be asking about you, and can you go over kind of maybe like an example on Dallas, what that looks like return-wise? Because
well, that's what I was gonna say. And before I do that, I don't know you guys' backgrounds. I don't know exactly where you come from in terms of your experience level and that kind of thing. Do you have any specific questions that I could, you know, just from what I said so far, that I could answer? Because I hate to be speaking sort of totally off topic and you're thinking, oh yeah, we already know all that. So, I mean, is there anything that specifically you can think of that you have a question about with regard to multifamily? Yeah.
So you're no longer with the firm in New York, right?
Correct.
You got your own thing.
Correct.
Okay.
Yeah.
And
Yeah.
you're the guy.
Right.
Okay.
Yeah, so I was in New York.
he's the man.
I moved to.
I was assuming that.
Yeah, I moved to Tampa. I actually worked for a REIT for a little while. Managed about $4 billion for them, and then now I'm on my own. Got a partner in Tampa who is got the #1 or 2, I don't know what it is, podcast in real estate right now.
You better say number
So-
1. You're on Facebook Live.
Okay. I know it's in #1 on certain categories. It's 6 million downloads or something like that.
What's
so,
it called?
Lifetime Cash Flow to Real Estate Investing. Rod Cleef is his name.
Who?
So,
Rod Cleef.
Yeah. So, and he's owned over 2,000 homes and multifamily units over the years too, so it's got a lot of experience. But anyway, what was your question? Sorry, was it just kind of where I'm at
Yeah, I was
now?
just wondering what your position is now. So it sounds like you have your own. What's the company called? I'm sorry.
Yeah, our company is REM Capital. It's very original. It stands for Real Estate Management. It's not the 80s band. Some people who are old enough to remember that.
REM.
I don't think I'm that old, but I listen to REM. But anyway, well, if you guys don't have any questions, so I was going to jump into just kind of giving you an example of one of the deals that we did. And again, if you have any questions, feel free to stop me. I mean, this is a small group. So.
Do you have any deals that you're putting together now?
Yes. We always have LOIs, letter of intent, that are out, and we're working on deals. So we've actually got one that we're working on, hopefully closing in the next few days. We've got about 5 LOIs that are out right now on different projects. Atlanta.
Are you looking for investors currently?
Always, yeah. Yes. Yeah.
That's like the only reason he's here.
I figured so. I figured so when you said you're getting ready to close, so you probably already have your investors.
No.
On
Yes.
that one, yeah.
So we do have a good group of investors. We're always looking to expand that group. And I actually prefer, ideally, if I can get to know somebody before a deal is ready to go, because I feel like it gives us a chance to get to know each other. And I'm dead serious when I say, if somebody comes to me and just says, oh, I've got this money, I'm like, wait, stop, let's talk about it. Let's really dig into what are you looking for, what's your risk tolerance. It's almost like if you would picture you're going to Morgan Stanley or somebody and they sit you down and say, well, what are you doing here? I just feel like that's the right thing to do. And I'm not the kind of person that's going to say, oh, you should take all your money out of the stock market, it's terrible. No, there's a place for that. There's a place for townhomes, there's a place for there's places for all these things, and really building a well-rounded portfolio is important. I think there's a big place for multifamily, of course, but anyway, so. Yes.
Is there a minimum buy-in?
Yes, so our deals, there's a couple of requirements on our deals. One is that you have to be accredited, which, do you guys know what that means? Somebody wants to get. Basically, you gotta have a net worth of $1 million, not including your personal residence, or you make 200 as a single, 300 as a joint. So you have to be accredited, and then you have to have, generally speaking, it's 100,000 minimum for our projects.
We'll be doing a follow-up call, guys, like a Zoom call and emails, and Grace will organize that. So any questions that don't get answered or you want further explanation on, Lyndon and I can help, or Robert's pretty accessible as well.
Yeah, absolutely. Yeah, no, I'm happy to. I left my cards in the car, so I'll bring them.
Yeah, I was gonna say, we need your business card.
Yes, definitely. And then what else is it? Oh, and just a side note, going to what you were saying about requirements. So one of the reasons that we try to keep our investor group, I don't know if you'd call it more select or smaller, whatever, is that we really like to be able to give each person a little bit more individual attention. And so one of the things that we do is we do a lot of updating with our investors. So it's almost like a mentorship program as opposed to just here's my money and send me a quarterly check type of thing. So we'll do webinars, Zoom calls, video updates, share financials, all kinds of good things. And that's really one of the other benefits that I find with, there's a couple other groups that do something similar to us. There's not a lot, but I really feel like it's important because it allows you to become more educated. And again, the more educated you are, the more intelligent decisions you can make, because you're gonna know, hey, I know the questions to ask when I go out there and I look for other investments. So that's one of the reasons, some people say, oh, it seems like a lot of money. It is, but we like to try to keep that to a, 20, 30, 40 folks per project. So, and we do have a pretty good group of investors, but again, it's nice if we can have somebody that says, hey, I've got $1 million, and I say, great, let's spread that over 10 deals. And it just gives a good diversification, it gives a good ability to kind of manage risk, and do some of the things that I think are really important. So.
Do you ever keep your properties for a certain amount of years and then sell them? Is that your?
So we are much more of the long-term buy and hold type investors. We're not fix and flip type people in general.
You keep them like for 7 years and sell them, there's no number like that?
There's no number. I generally tell people that we'll start at 5 and we'll go to 10. So somewhere in that range. And there's some thinking behind that. Probably the biggest thinking is when it comes to market cycles. So we are, again, kind of going back to what Sam was saying, we are very on the conservative side, not crazy conservative, like the sky is falling, but just, hey, we've been there, done that, and we'd rather be over here.
Right.
So I like to tell people we're somewhere between a retirement return and a good return, sort of in that profile, that risk profile. But yeah, so one of the things that's really important for us is, generally speaking, a market cycle is 10 years. I mean, I know we could sit here and debate, but generally speaking, market cycle is 10 years. So we want to have a full market cycle time frame to where we're not saying, hey, we're going to be in and out in 2 or 3 years, and then oops, we hit a recession. Now what are we going to do?
Right.
We don't want to be that guy or girl, whatever you want to call it, that company. So we'd like to tell everybody, hey, we're going into this long term. There are tax benefits, there's compounding, there's a whole host of other things that come into play, why we think that way too. But the bottom line is, if you want to kind of put it into a nutshell, it's basically like a Buffett mentality, but in real estate. Buy value, hold on to it, and you'll outperform.
Don't lose money ever.
Exactly, and don't lose money. Exactly. That's the other thing too. I mean, I have told many people on the phone when I talked to them years ago. I had a hedge fund. I was, New York City. That's why I kind of moved there originally, was to do technology hedge fund, of all things. And the market crashed. And I knew a lot of people that were in the hedge fund because they were friends, family, people that I knew. And for the next 4 years, I took money out of my own pocket to repay them some. I mean, I couldn't repay them completely, but I did that on purpose. And I think that was one of the best things for me personally, because when you do something like that, it just burns into your brain. Hey, let's not do that again. And it wasn't my fault, but could I have been more conservative? Of course. I mean, you're not playing in the pre-IPO technology market of the late 90s and taking low risk. So, but anyway, so that's part of why today, that's at least on a personal level, that's why I'm a little bit more careful about that on the deals that we do.
So, oh, sorry.
He had his hand up, so. What's your name, by the way?
Danny.
Danny, all right,
Yeah.
sorry.
So it sounds like you guys, do you focus on just like multifamily or?
Yes.
Okay, just multifamily.
Correct.
Okay.
Yeah.
We are, Lyndon and I are buying assisted living facilities with a different partner,
Okay,
very similar to Robert,
right,
way more experienced than us, very, very smart and ultra conservative individuals.
okay,
I'm also building in Boise in Utah. Not all of that is multifamily, but, so Lyndon and I focus on a couple different asset classes with strategic partners. Robert is our number one multifamily partner.
okay. And, do you have people that are kind of in like the hospitality space or like hotels?
That's a space. We can laugh about that a little.
Awesome
Awesome space.
something?
We almost
So
did, yeah.
our assisted living partners, they build hotels.
Oh, okay,
But I'm laughing because we underwrote a deal in New Mexico, and we had an LOI out, and then they wanted cash close in a couple weeks, so we backed out. But we ultimately decided we didn't have that strategic partner, and we're not experienced enough.
right,
So we said, okay, let's pull back, stick to assisted living. We have a partner that can build hotels, but operating and holding a hotel, let's be smart about this, conservative, that's not us.
okay.
So we'd love to have a strategic partner that is absolutely geared up for that, but we don't right now.
And we may join them on the assisted living, but again, we have the same philosophy. Don't be the operator unless you know what you're doing.
Right,
So for me, development, check, multifamily, check, office, check. Anything outside of that, find somebody else.
Yeah.
You know?
totally.
So, and there's plenty of good asset classes out there. You can make money in industrial and all kinds of stuff. But again, does the operator really know that space?
Yeah.
If they do, you'll probably be okay. Not everything's a home run, that's life, but you'll probably be okay. So I think that's important. Yes, sir.
Yeah. So what I heard you say is that you go looking for the properties that are already there, maybe rehab it and then upgrade it.
Correct.
And then, get the equity and so on,
Correct.
right?
Yes.
Yeah.
Yeah.
So not a
So
new
far-
construction, you do new construction too.
Right.
What you're
Yeah,
talking
so
about
far,
is-
all we've done is existing, stabilized, for the most part, properties. One of the things that, again, partly where we're at in the market cycle, we're going to probably shift a little bit more to the development side, whether it's affordable or maybe market rate, but in certain markets. Again, there's a different risk profile associated with that.
Yeah.
So, I love development, but it's riskier. You can make more, but risk reward, right?
Right.
So there's certain things that you gotta make sure you do, and then again, if somebody came to me and they said, hey, I've got $1 million, I'd say, okay, we're only gonna put 100 in the development project. You'll probably double it in 2 years, whereas you could take the other 800 and make 200, on a safer, but again, you don't wanna be super risky about that.
Yeah,
So-
just to follow up on Linda's question, what would be the exit strategy if you're holding on for, let's say, long term, and there is appreciation, depreciation, whatever, right? But if an investor wants to get out, how do you go ahead and manage that?
Good question. So there's a couple different things that we do in our deals. One is when we go into a deal, we always have the ability to take what's called a supplemental loan. So it's kind of like a HELOC for a house, except it's not separate. They really roll it all together. And so in a rising interest rate environment, we'd rather keep the 70% at 3.9, 4%, whatever it is today. And then if it goes up to 5, great, I'll take an extra 20% at 5%. I'm not paying 5 on the whole thing. But that's what we do, so that's number one. Usually year 3 to 5, we're able to do that. Because we're buying properties where they've got a 20 to sometimes 40% upside through value add. So we might buy it for 10 million and 3 to 5 years later it's worth 14, let's just say. So we're gonna take out maybe 3 of that million back out of the property, return that to the investors. So now they go from investing 100,000, now it's down to 20. They're still in for the full equity amount, still getting that cash flow, still keeping the appreciation, but now they can take that 80, go redeploy it on the next project.
That's
So
a
that's
non-taxable event.
exactly. So that's the first, what we call liquidity event in our projects. Now the second would be down the road, if we decide to keep it longer than 10 years, two things. One is, if I go to the investor and say, hey guys, do you want to stay in this deal? And everybody says, no, we want out. Okay, no problem. Maybe I want to keep the deal, so I might buy them out. Or I might say, okay, you know what, we've had a good run, let's move on to the next project. So those are kind of two things. Now,
What if we just decide we don't like you?
well, I was gonna say exactly. So the third thing.
Yeah.
No, absolutely. It's a good question.
Where I was coming from is, let's say, I mean, you have, let's say, the Dallas property, which is doing good.
Right.
Right? And then you're going into another area which has got a better, possibility. Then I say, I don't want to lock in my cash here.
Right.
Why don't you take this and move it there?
Exactly. So there's two other scenarios.
Right.
That's one, and then the other is, what if you decide you don't like me? Or you decide, or you have a life event. Something happens, you say, I need the money. So to address the first one, every year I look at every single property, and I basically look at it and say, what do I think is going to happen in the next 12 months? So here's our existing portfolio. What are the opportunities that are out there? Does it make sense to take some of this money and roll it here? Because again, I'm responsible for your investment. It's not, you gave me your money and we shoved it into a deal and okay, have a nice life. What are we doing with this capital? Because this capital needs to be just as efficient as new capital. So that's something that I look at every single year. And so, again, maybe some people say, I want to stay in the deal. Okay, so maybe we'll just leave it. But if it becomes a severe imbalance and we're getting 10% here and I can swap that money for 20% over here, it's going to make sense to trade out of this one and move over here. So yes, I think that's something that a good operator, somebody that knows what they're doing, is always thinking about. You don't just say, I got these people in the bag, they're good. Move on to the next. Well, wait a minute, what about these guys? I mean, you're just as responsible to them as you are the new people or the new money. So I think that's important. That's something that I look, like I said, every year I look at every property. I'm looking at the market. Has the dynamics in that market changed? Maybe the neighborhood was going up, now it's started to roll over. That happens, especially over a 10-year period. We try not to get into those situations, but it happens. So you're looking at the market, you're looking at the bigger economy, what's happening. Next November, regardless of politics, things change, people move into different positions, who knows what's going to happen.
I guess if I just follow up on that, unless somebody else has a question.
I was going to ask, if you had any of your own cash in the deals usually?
Always, yes, yeah.
And so do Lyndon and I, we don't like to pitch stuff that we're not invested in as well.
Yeah, that's really
Grace is the same way. Grace has been a really smart, she does all the research beforehand, and then she risks her money, and then she tells her friends about it. That's what I love about Grace.
So what percentage do you put in deal?
We don't have a ton of capital, we're usually doing the minimum.
Okay, it will be what, 5%, 10% of,
Yeah, usually as a partnership group, we're between 2 and 10%.
Yeah.
Sometimes more, like in Dallas, we were actually 20%.
Sure.
But usually I tell people 2 to 10. I know that's a big range, but if I've got a deal like Dallas is a good example, we had $1 million tied up just in pre-closed funds, escrow, attorney, lender deposit, so it's a lot of money.
Right.
So for me to have 5 deals out there that I'm trying to put together, it could cost. So sometimes I might say, okay, I got to pull this and move to the next deal. It's not that I don't like a deal, but I'm running a business as well as trying to manage the portfolio. So it depends, but we always like to have something in there. That's important for us.
Did we answer the question of how to get out? Like, let's say.
Well, yeah, I was going to say, so the last question was the life event or something like that, just sort of a personal preference. And you say, hey, you know what, I just decided it's not a good fit. So in our documents, and I'm sure everybody has a different way of doing this, but in our documents, it specifically says that you can do that. Now there's a process. You come to us, you say, hey, it's not a good fit or whatever. And again, you're trusting in us at the end of the day. And I mean, that's the bottom line. If we decide, if we want to be jerks, we can be jerks. So that's why it's important to know that person, because you're saying, hey, if I'm in a situation and I come to you, how are you going to treat me? Are you going to treat me with thoughtfulness and care, or how's it going to work out? So yeah, in our documents, somebody can come and say, hey, I'd like to get out, and then we do 2 things. Number 1 is we'll take it to the existing investors, and most of the time, if the property's doing well, somebody's going to say, oh yeah, I love it. In fact, I joke, when whenever somebody comes to a site visit with me, they always walk away and they're like, can I put some more money in this deal? You know, because they see it, they say, wow, this is amazing. This, you know, they really understand what's going on. So that's number one, and then number two is we can buy the investor out as well. We always have that option. Now the only caveat to that is that you're probably not going to get your maximum value when you do that. Because again, you know, let's just say 2 years from now, the economy takes a little bit of a correction, and you say, well, I want to get out. Okay, but it might not be, you know, the double your money projection that we thought. It might be a little bit less. So, you know, again, just, I think the bottom line is we want to be fair to, you know, again, I look at it as we're all partners. Even though it's technically not a partnership because we're under LLC rules, we're a partner. You know, members, partners, whatever you want to call it. So that's the way we look at it. And, you know, one person is limited, sure, and one person is the manager. But, you know, treat people right, and at the end of the day, it usually works out.
So how do you do multi-asset syndications? Like
No.
where you raise a bigger fund and
Right,
do
a
5
fund.
or 10,
Yeah, so we haven't done that yet. REM Capital as a company has only been around for about 2 years, maybe a little bit more than 2 years. So relatively speaking, it's new. And generally, when you do a fund, you want to have enough of a pipeline and enough of a large investor base that, well, not necessarily investor base, but really enough of a pipeline to where you can bring money in, put it out, bring it in, put it out, you know, that kind of thing. Because if it gets stuck in that fund and now you're paying a return on money and you don't have a property that's generating cash flow, you can get yourself in trouble.
Kevin's doing that right now.
Kevin Buck, right.
He's got $3
Right.
million.
Right.
So the idea is you don't want to have that money sitting in a fund and all of a sudden not have a place to put it. Our mutual friend, really good guy and really good, smart investor, he just at the last minute canceled a few purchases because it wasn't the right fit. So now he's got $3 million in a fund he's got to make a return on. So if you're Grant Cardone and you have a deal flow that never ends, then, or, you know, or someone like that, then a fund is much more viable. So when we get to the deal flow, that's all absolutely goal, right?
Yeah, and it's more difficult for somebody who's picky. I'm not gonna put anybody down.
I'll say right here, Grant Cardone is buying A-class. I mean, I could buy 1 million of these if I was buying my Grant Cardone.
It's just when you're picky about it, and we have a very strict criteria that we look for, and it's not easy to find, and there's a lot of people looking for the same thing. So it would be difficult in this environment for us to be successful at a fund. Now you never know, things can change, but I'm just being totally like, hey, don't beat around the bush. Realistically speaking, for me to find that many deals right now is tough. And if I had a fund and I had all this money sitting there, subconsciously I'm gonna be like, oh my gosh, I gotta put this money somewhere. I do not wanna be in that mindset at all.
So even like, even in a market downturn, you wouldn't want to kind of raise capital to, because a lot of fund structures maybe outside of multifamily or other real estate investing, you don't have to deploy the capital, you know, right when you close.
True.
You have maybe a 2-3 year investment period. I'm just curious if you've thought about like raising a fund to do that for this next cycle.
Yes, we have, absolutely. And to your point, there are times in the market where you can get away with that. Where you can basically say, hey guys, we've got a track record, we know what we're doing, put your money in here, and when we find a good deal, we'll use it. Right now, there's just so many people out there with all these deals that nobody wants to have their money sitting around. You know, they're like, oh, I'll go on to this deal, I'll do this development deal, I'll do that. You know, so it's more difficult. When you get into, like you're talking about, a market downturn where there's nothing, you know, you're good. You know, there's crickets in the market. That's when people say, hey, you know what? You guys know what you're doing. Please take my money, and at least I know I'm like first on your list. So yes, I think we will be able to do that. But right now, again, the market dynamics just makes it more difficult, and we really, really don't want to be in a situation where we're feeling pressured to do a deal that we don't feel comfortable with.
So on that subject, I want you and Lyndon to go over underwriting this deal. We didn't even tell Robert about this yet because we weren't sure it was worth your time. So Lyndon and I underwrite deals if we think it's like, okay, we can probably buy this. Then we call Robert and say, okay, you know, Jedi Robert, take us through this, and and
Surprise.
Jedi Master.
Wait, where's my notes?
So,
Right?
Heads up though, this is a very, very bird's eye view.
yeah.
It's not really nitty-gritty. It kept it very simplified.
You're good, you're good.
The other tricky part was this is actually kind of good. This is actually a portfolio deal, so it's actually 3 properties that we were required by QSO. To pull it out was a little eventful.
Yeah, we need to find easier deals to underwrite.
Yeah,
We keep
so,
finding these portfolios.
I don't know if you guys have looked at deals, signed non-disclosures, blah, blah, blah. Sorry, didn't. You're gonna get slammed with a couple of documents. Sometimes they're in Excel, sometimes they're in PDF. And then you have to convert it to Excel, which is a pain in the butt. You'll get a handful of deals like this. I was just kind of showing you guys.
What's a P&L?
P&L, profit and loss statement, right here.
Awesome.
So you get a statement like this. You can only look at it. You can't manipulate it. You can't do anything with it. It's cool to look at. This was the P&L for one of the properties. I just wanted to show you what it looks like. This one's kind of interesting though. You might like this. Internet expenses and cable expenses.
Oh my gosh.
Nice.
22, 23 grand that the landlord actually pays for. So,
Wow.
Who watches cable anyways?
yeah. So that's just an example. And then you're going to get a rent roll, also in PDF. And what are you going to do with it? And this one took a couple days to get to. This was valuable information. This was how many bedrooms they were, because you're also trying to find comps. You guys know about finding comps. By the way, I'm not a realtor. I did not mention that earlier.
But he's getting his license.
So, looking for comps, trying to see what the market rents are, what Robert was talking about, seeing what you can do when you're playing the value add. This is what they gave us. So this is converting it. Oh dang, it's gonna convert over. They said their income was 950 grand. Expenses, I put that in there, that's for a little bit here. 29% of expenses, income. Other income was interesting on another property. I didn't put it up here, but security deposits held, pet income, washer dryer, things like that. So this is their cap rate and their listed price based on their net income. Yep.
So on these slides, where's your debt service?
So I took that out actually, great question. So when we're analyzing a deal, we're gonna have different, when we buy a deal, it's gonna cost different. So there is no debt service built into these expenses.
But when you send it to us, won't you have that factored in?
Yeah,
Yeah.
definitely.
This is high level where I think you're like one slide ahead of the game.
Yeah. No, great
But yeah,
question.
absolutely.
I'm curious,
That's how we'd like
how many of you guys own rental real estate? Okay, so a lot of you, so you're pretty familiar with it.
And if I go too fast, just stop me like that.
Just was curious.
No, so they had debt service on here, which was included in their expenses. And also this 29% of expenses does not include other income. So their total expenses is actually really low when you agree, probably around 25%.
What do you think they should be, Robert? I'm curious. If it's a 2005 vintage, there's not a lot of.
I got a picture of it right here.
Yeah, I mean they're fairly clean units.
In Missouri,
Springfield.
and the landlord
Solid
is not
B-class.
paying utilities?
They are paying.
They are.
They are paying utilities.
And cable.
And cable.
internet.
And cable internet. Yeah, that's true. So that should be about 50% or more,
Yeah.
maybe 55.
So I highlighted
So,
that on this deal
yeah.
for a reason.
Yeah, because you're
Um,
gonna talk about deferred maintenance.
Yeah.
Good job.
See where we're- So here's the summary offer, list price. Like I said, it's a very high level still. Can't see what's going on. Gross potential income, I just grabbed the average rent. That's what we're able to get. Took a 10% vacancy rate income. So for our scenario, we took 50% like Robert just said. So we have operating income. Take the same cap rate they offer. Huge discrepancy as far as what list price is and what, hey, how's a real, over 38%. Probably not gonna interest a guy when I come in and say, hey, we're $3.5 million less than what you're listing for.
Did you put an offer on?
We're still waiting for info.
I was gonna say.
Well, we're gonna write an LOI.
They didn't laugh at you yet?
Well, we're in the so we're actually, I think on this other slide, I had something where it's been hard to get information from them with this. So, and that's part of the time process is you get a little bit here, like, oh, can we get this, can we get that?
We've been waiting to write an LOI on an Albuquerque deal, but we still don't know what one of the buildings in the portfolio even rents for, how many units.
That's a quarter of the, so 25% of the property, we have no info on rent, from that, and that's part, I don't know why we're looking at portfolio deals here. So this is one of three. This is.
But when you, I take it that you go and visit the property because you have to know in what picture it looks good.
We're not going to
You go
visit.
there, as Robert was saying, right? You take a look through your experience and immediately you say, hey, this is gonna cost me this much
Yes.
to bring it down to that level.
So,
We have, well, go ahead.
I was gonna say, Robert's 200 deals before he
Yeah.
buys one
Sure.
were the same. Absolutely, there's no way we're gonna close on something without looking at it.
We run through
Yeah.
basically a 7-step process.
Mm-hmm.
So step 1 is we do our initial pre-site visit due diligence, which is all online. You know, we're not going anywhere. I literally do it all from my desk. You know, Google Street View, city data, all that kind of stuff. So we're gonna build our initial offer price based on that. Now that's based on what people tell us, so we're gonna ask about deferred maintenance, we're gonna ask about, you know, all that kind of stuff. We haven't seen it, but we're gonna have to, in other words, I don't wanna be flying around the country because I would literally spend nothing but just flying around otherwise. So I take what they give me, I make an informed decision, we submit an LOI, that's step 2. Then, between the LOI and the purchase and sale agreement, that's where we're gonna do a little bit more homework. But really, we're gonna wait until we've got that PSA before we do the on-site due diligence. That's where we're flying there. Although sometimes, usually what happens is I fly between the LOI and the PSA, because I got a pretty good feeling about it. So I'll fly there, but then I'll send the team in after the PSA is done, and they walk every single unit, and they've got a page of trim, doors, handle, like every single line item. We take that, then we compare that with what our initial estimate was, make sure that the number is still good, and based on me looking at it, like you said, you know, I might look at 10 or 20 units, but I got a pretty good idea, and talking with people, you know, that kind of thing. And then after that, if we need to go back and renegotiate, we will, but we'll base it on, hey, guys, you didn't tell us that there's $1 million in, you know, roof repair that you didn't mention. And so we got up on the roof and it's just completely shot. You know,
What he's talking about with repairs, we actually called a property manager in the area. We had a conference call with them, and they actually, the people that own this run a construction company, and there's, because another person was looking at buy it, and there's they have a hunch they're running some of the repairs and deferred maintenance through their construction company, which isn't going to show up on here.
Yep.
So
kind of we need to repairs and maintenance. Is like,
you know, also helps. We have.
That's why I went back to this page. So
It helps to have a big network as well, which is nice about Rod and Robert. And you know, we were just looking at a Kansas City deal. We did submit an LOI. We had a mutual friend out there. She drove the property for us, so it's pretty easy to get boots on the ground, especially if you're interviewing property managers. That's what Linda and I did. We said, hey, who's the best property manager in town? We called. She was fantastic, super knowledgeable. She said, oh yeah, no, I've been in that unit all the time. It's one of my main competitors. And as a property manager, what our company does is we go and walk our competition. So I know that they have white appliances, they have laminate countertops, they have linoleum that's kind of buggered up. It's 15 years old now. She knew exactly what was going on. So there's a lot of kind of tricks that we use that, you know, and if we buy the property, we'll use her because she was fantastic. She was a huge asset.
she also pointed out, because we asked about internet and cable, and apparently that's a thing in this area to offer internet. That's just something.
But cable is not, right?
The cable's not.
Okay.
The internet was still. I was looking at the comps. People still offer internet, but it's just something they were doing to compete to get more residences. So that's why this owner still pays for it.
Is it, I assume because you guys have done so many deals, like, it would be pretty rare to actually need to renegotiate. But, so I'm curious, like, throughout the years, like, has that changed with more experience and, you know, knowing what to look out for, or do you still need to do that every so often?
yeah, and I think the hardest thing is when you have more experience and the seller is lying to you and you're underwriting it based on what you know is true, even though they're telling you it's not, and then your offer looks bad, and so then you have a decision to make. Okay, well, I can either change my offer or keep it that way, and I could lose the deal if I don't change it. So what I do in those situations is I go back to the broker, if there is one, and I'll say, hey, how do you want to play this game? Do you want to go in with the truth, or do you want to play their game and then renegotiate? And I let them make the call, because it's their relationship. So, and usually that works. But most of the time, yeah, we go into it basically knowing, yep, we're $1 million off, We know exactly why. They don't want to tell us about it, but we're pretty sure we're going to find it. And so, you know.
So usually it's not our mistake, it's
Right.
because something was hidden from us. That's really the only reason to retrade, right?
Or sometimes they don't even know. I mean, honestly, it's amazing to me. I mean, like Dallas is a perfect example. I mean, these guys have deals all over. I don't know how many units they have. They've been at it for a long time. And you just think, how do they not know this?
Yeah.
But a lot of operators are not super hands-on. And I don't say that I'm a micromanager. I don't want to be a micromanager. But there's a lot of details that I like to know. Because at the end of the day, any one of those can kind of screw things up. So, you know, I like to really know what's going on, and I think that helps when it comes to making a good offer. And it also means sometimes we lose deals because, you know, in fact, it's funny, we had some friends who bid on the same project we bid on. I didn't know it at the time. We lost the deal. We were talking, I don't know, 3-6 months later, whatever it was, found out they won the deal. And I knew what they bought it from. I'm like, man, how did you underwrite that? But their assumptions were very different. They assumed they were going to spend much less per door, they were going to get more rent, they were going to have lower vacancy. So, you know, I start putting that thing together and I say, well, okay, yeah, I can see how you come up with a higher number. So, and again, it doesn't mean they're wrong, and it doesn't mean they may not hit their numbers, but we're a little bit more conservative, and we like that fudge factor. We've got a property right now in Ohio that tornado came through and took out all 101 units. So we've got a massive rebuilding process, and we had to relocate, I don't know, probably 350 tenants. But at the end of the day, we're not going to miss a beat. Literally, I mean, the investors are a little worried. You know, people are emailing me, hey, is everything okay? Did we just lose it all? But, you know, we had the right insurance, we had enough working capital, we had good relationships, we had good people, and we're literally just, we actually, I mean, I don't want to be overly, you know, optimistic, but I think we may actually come out ahead at the end of the day. But that's because we were conservative and we were careful going into it. So, anyway, not good.
No, I just wrapped this up because I know it's getting late, but I just want to throw this on here too. Typically, when you're looking at a value-add property, we're seeing how we can raise rents or pull more value, or opposite, reduce expenses. Because in the other end of the spectrum, let's say that was a 55-60% expense instead of 30%. How can we cut those costs to, you know, create whether we raise rents or decrease expenses? So, anyways, assuming we bought it for a 24% discount, which is highly unlikely, but you never know. At current rents, you'd be able to achieve a cash on cash return between 7 and 12%. Like I said, I kept this on a super high level, extremely simplified because I didn't know what we were.
We're pretty confident in a $100 increase, though, right?
Certain units, yeah.
50 for sure.
50 for sure, but most units about $100 on this property. But you're required to buy 2 of the 3 in this deal. So one of them is there's absolutely no room to raise rents on the other property. So yeah, that's just an overview of what we're looking at.
I want to throw one other thing, just food for thought for you guys. So I would say on average, we lose a deal by 10% of the purchase price. So it's a $20 million deal, actually not even that, maybe, well yeah, it is about 10%. So a $20 million deal by about $2 million. So you might think, well gosh, you know, what's another 10%, big deal. But think of it in terms of leverage. If you're getting an 80% loan and you have 20% equity, that 10% is worth 50% of your equity. So if you go into that deal and you paid an extra 10%, you now just gave up 50% of your return, just like that. So that's why those numbers make a big difference, and that's why we'll walk away from a deal, because you look at something like that and you say, oh yeah, but it's just a couple $100,000 more. Yeah, but think about what you have to do to make that back. So again, that's...
I love that you're saying that, because I wanted Kansas City to work out so bad.
I'm sure you did.
Like, I love Kansas City. I lived there. I lived 5 minutes from that facility, and it was eating me up that we're going to lose that deal over a couple $1 million. But it was the right thing to do, and it stinks when you find a really cool property and it doesn't work out. It really stinks. But the end of the day feel good. I wanted you to tell a story though really quick about the insurance adjuster in Dallas, because this is one good example of why it pays to be with the right partners and to learn from. I love the email I got from you. I'm a limited partner in Dallas. We gave our money to Rod and Robert, and I just get these emails like all of our other investors. So what they were going to give you how much for repairing the roofs and ACs?
Yeah, so it's a 208 unit complex. We had a big storm come through. You guys might have heard about the crane that crashed on a brand new apartment complex, took the whole thing out. That brand new apartment complex is a complete loss because of that crane. It's like a,
Jeez.
I don't know,
That's in
massive.
downtown Dallas?
Yeah, it's crazy. Anyway, not to sidetrack. But so we had the wind damage came through and had the insurance company, had the property manager call me and say, hey, we got some damage. Okay, get the insurance adjuster out there. They come back, they're like, I think you've only got maybe $25,000 worth of damage. You got a $50,000 deductible. So I'm thinking, well, okay, then obviously we'll just pay cash. But knowing that trust but verify, so I said, you know what? Let me get some pictures. So I got the pictures from the property manager, actually the district manager. And I'm looking at the pictures and I said, I don't know, this looks like a lot more than 25,000. I think it looks more like 250-ish. Got a different adjuster out that I hired, went out there, and the guy said, oh yeah, you're looking at $500,000. Okay, so even my number was conservative. So immediately got the claim filed, got the adjuster, started working with our construction company. End of the day, it was $1 million. So yeah, you're right. I mean, that's the kind of thing where I don't know that they were being purposefully sneaky.
They're insurance. It's an insurance.
I don't know.
company.
I mean, to be that off, yeah, it is a little questionable, but
So I would not have probably known to call out my own adjuster. That's why I'm strategically partnered with the right people. Again, I'd rather give up some of the glory and the money of being a syndicator to have the right partners involved. I don't need the whole general partnership, all the money on my own. I'd rather be with Robert and Rod and Lyndon and Grace and people like that and have multiple eyes and experience. And again, back to what Robert said, go for the right people. When you're buying in a syndication, you're buying with a group of people. The deals will take care of themselves if we're underwriting them correctly, but absolutely there's people that would love me to raise money for them, that are asking me currently to raise money for them, and I would never raise money for them, even though their deals are awesome. The deals are really cool, and I just would never do it.
you want to know the rest of that story?
Yeah.
I haven't told everybody yet.
Okay.
So, we, at the closing, we got an insurance, got an invoice from the insurance company. We got a certificate of insurance. We got a statement of coverage, whatever you want to call it. Everything we needed to close. And I checked it, I looked at it, we paid the bill, $35,000, whatever it was. They cashed the check. Come to find out, the person at the agent's office never bound the coverage. Now we found this out because we went back to do our claim and the carrier's saying, we don't have you on the policy. And I'm saying, yes you do, it's right here. No, we don't have you on the policy. So the agent, somebody in the office at the agent, never bound the coverage. So now we have to go through the E&O, which is the next step.
No way.
Get that coverage involved, get their adjuster involved, go through the whole process again. It'll be okay, but that's just the kind of things that happen on a daily basis. Nobody was doing anything purposely wrong. They're just incompetent, and they've never known.
They don't know.
That's crazy. My cousin's house was not insured for 12 years, I think. He called the insurance company to refi, and they're like, no, we have a different house covered under your name. Oh my gosh.
Wow.
12 years later, he found out he didn't have. Yeah, it happens. Incompetence is out there. And there's a lot of syndicators that are incompetent, that are buying deals they absolutely should not be. Would you agree?
Yeah, I think the one thing I would say to that is that there's a lot of guys that are making good money out there, and I'm not going to say anything against them because they have a different perspective. They've been in the business since 2011, 12, bottom of the market, anybody could buy real estate and make.
You look really good if you started back then.
Right, right.
You look really good. If you
And it
started.
doesn't necessarily even mean that they're gonna lose a bunch of money when the market corrects. But if they continue to use the same underwriting, they will. And that's what concerns me.
Yep.
Is because they're not leaving money on the table. And right now you're getting away with it because you're basically borrowing from next year to make today's deal work. But 2 years down the road, you made enough to make up for what you lost and you're still ahead. So you look like you were right. But the fact is, one of these days it's gonna level off and the money you borrowed from tomorrow isn't gonna be there tomorrow. And then what do you do? So that's the only caution that I give to some of those more aggressive deals.
Yep. So I wanted to segment, then we're gonna be done, because I think we went way over time.
Yeah.
But Robert and I,
Just
oh, go ahead.
Yeah, just one question. So just to put some numbers, let's say for 100K. So over the deals that you have done and then, the investors, what has been on the low side, what has been the returns, on the high side, what has been the return? Just
Well, I was gonna say, you can speak to the development side of things, I can speak to the stabilized multifamily. We target a 10% cash return over 5 years. Now, usually it goes up from there, but I use 5 years as kind of a benchmark, if you will. And then 15% IRR. So total compounded return, internal rate of return is compounded 15%. So.
Okay, this including the equity appreciation.
Yes, so we like to see basically 2/3 of that return in our pocket in cash today. Now, if it's 2012, I might have said, I can put 2/3 in appreciation and 1/3 in cash. I'm okay with that. But I knew that I had a lot of room to move. Now, the more the market moves up, the more I'm kind of pulling back and saying, I want more cash and less hope.
And the distribution itself is done on what? End of some period? Or
Yes,
period?
we do every quarter. Yeah, of course you can speak to however you guys do that, but.
Yeah. No, yeah, so I'm in the Dallas deal and we just got a distribution, right?
Mhm.
Was it a little bit higher than you
A
estimated?
little bit, yeah, yeah.
You probably don't want us to get used to that, right? Just in case.
Well, we like
It's a
to
pleasant
under
surprise.
promise, over perform, right? That's
So when we were pitching that deal, or you were pitching that deal, it was the average return was expected to be 8% cash on cash. That's the preferred return.
Mhm.
You guys know? Does anybody not know what preferred return is, or should I go over that?
Isn't that before the sponsor makes any money?
Yeah. So if you give, let's say I'm doing a syndication, you give me $100,000.
Yeah.
This year you're going to get 8%. If the pref is 8, the preferred return is 8%. You're going to get 8% this year.
Right.
So 8,000, 2,000 per quarter.
Right.
After that, there's always a split. So each syndicator is different, each operator is different. After you've received your 8% preferred returns, a possible split would be like a 70-30 split. 70% of the profits after that to you, 30% to the operator. I'm, syndicating to make money. The nice thing is when there's a pref, you make money first. And I think that's really important. Now on the development deals, we're not going to do a pref. The development deals are longer, a little bit longer plays.
Well, there's no distribution typically in a development deal. It's you put your money in and 2 years later you get, or 3 years or whatever it is, you get it back plus profit.
So that's one way to do it. We are probably going to be developing both sides of things. So if it works to sell in 2 to 3 years, great. The markets that I'll be building in, Boise, and Robert, if you're on that, we probably want to try and hold for 3, 4, 5, 6, 7 years, fully stabilize it, so there would be distributions. But the market's going up so fast there and in Salt Lake that maybe we don't do distributions and you get a huge capital play in 2 to 3 years.
That's a good point. So yeah, when you're doing a development to keep it, then what you'll do is you'll buy the land. Usually the partners in the deal will buy the land. So they'll own the land, which is a smaller chunk of the deal. They'll contribute that to the development. The investors will bring the remainder of the money. Usually you have to bring 30% for a development deal, give or take. And then what happens is when that development is done, it can be reappraised by the bank, and they will usually give you a new value, and you'll go to a permanent loan. And at that point, you can take some of that recapitalized money, return it back to the investors. So there's kind of a liquidity event at that point, but then you have the distributions that'll continue thereafter, so.
So there's different models. I have the connections in Utah and Idaho to build. That's what I've done. So the number one builder and I didn't tell you this, the number one builder in Utah just asked me to help them maybe possibly do something in Boise. My uncle's been building in Boise for 30 years. I'm from Boise, live in Utah now, so I have connections both. So we're going to be doing that. But also Lyndon lives in Albuquerque, and I kind of love that we're next to the Apple campus. Is it in, what is the
Spaceship.
Spaceship.
Infinite Loop or the street there? So I would love to have an infinite return. So it is super possible with a really, really heavy lift. So that's one asset class that we're going to be working on is the 20 to 30 unit asset class. Really, really heavy rehab. So you probably don't want to spend a lot of time at night in these locations. We're going to be adding security, you know, gated, make it a gated community, security lights, heavy, heavy rehab. But with those heavy lifts, you can pull your money out in 12 to 18 months, refinance, and pull all of your investment back out. At that point, you have no money in the deal, you've refinanced, you're cash flowing, that's an infinite return. That's a lot of work though. So
That goes back to strategic partners.
Yeah.
One of the guys now, because he's heavy in tax credits, HUD homes, rural developments, bond deals, things like that. So we've been actually on the phone for a while today. That just comes back to strategic partners. I mean,
he's a rock star in that. The only way we would do that is if we had someone. He has 5,600 doors under management. He knows that asset class. That's the only reason
That's all
we're
he does.
considering that. Robert would laugh at us if we asked him to do a deal like that with us. He'd be like, no way, I'm not gonna spend my time on that.
I'm not gonna go into a place where I might get shot, no.
But Bobby,
It's worth more than infinite returns.
Bobby and his team is very comfortable in that space, and I'd love to throw in $500,000 at a deal and get it back out in 18 months and tell you guys, guess what? You have zero risk. It's a non-recourse loan, so your credit isn't on the deal, and we're making a couple $1,000s a month. You're welcome. Tell all your friends about it, that you're making an infinite return.
Sounds like what I buy.
Yeah, very nicely. So,
And not all those deals are super dangerous either. I mean, I
no,
was kind
they're
of joking
not.
about
That was a
lot
little
of them
exaggeration.
are rural too. But
Right.
Yeah, they're rural. We actually really don't do war zones. The ones we're looking at in Albuquerque right now, they're not that bad. They're just kind of gross. You know, there's really, really a lot of deferred maintenance. There's one in Salt Lake I was just looking at, and same thing, just really gross, bad management. So different asset classes, different strategies. But I think the takeaway is be super conservative and know your stuff and have the right partners. Any last questions?
How do you find your properties?
20
words
really
or
good
less.
question. I call
I
brokers.
can't tell you that.
good relationship with brokers.
So I have a full-time assistant calling brokers.
Property manager.
I cold call brokers, property managers. I have a podcast which I'll love to get you guys all to listen to when it launches at the end of the month to pull in those leads. Robert and Rod have their coaching program, which they provide massive value to people, teach them, help them, brings in deal flow. So we're bringing it in from all those.
Yeah, I mean, I think the nutshell is your ability to just have a larger network.
Yep.
Because I mean, the deals we've gotten have just been totally random. I wish I could say there's a secret sauce that we use, but it's not. There's just no.
There's people that won't cold call brokers.
Right.
I'll cold call all day long. That's how I built my real estate business. So, but Lyndon's a relationship guy. He knows everyone. Everyone likes him. He's super likable, and he gets deals because of it. You know, maybe I'm less likable, so that's why I have to cold call. I don't know, but
So what percentages are on market versus off market deals?
most of them are hitting the market these days, I would say. What do you think, Robert?
Yeah, so again, it depends on the size, but once you get past, I would say like the 15, 20 million range, most of those are going to be on market to some degree. Now, I would say a lot of them are going to get traded as what we would call a pocket listing, which is where the broker's got it, but he's just handing it out to
broker.
What's that?
He's a
Oh,
commercial.
so you know. So so people are just they'll call me up and say, hey, Robert, I'm talking to you and 3 or 4 or 5 other guys, let me know. That's I would say that's probably half of the deals. And then you have the guys that they will take it to market every single time because that's all they know how to do. And I don't like working with those guys. But I get it, you know.
They do a good job for their sellers.
They do. They do.
The seller wants max exposure, right?
Right.
Yeah.
Absolutely.
It's the smart thing to do as a broker and seller in this market.
Right.
Unless you know for sure this guy's gonna pay a good price and close. And we know he'll close. You and Rod have closed almost 100 million this year, right?
Yeah.
How many of your deals are cash and how many do you finance?
I have never done a cash deal.
Yeah, I was gonna say ours are all financed.
So
not
you
really-
don't leverage in?
Yeah.
Do you cover the debt coverage ratio? Is that kind of your benchmark? Or do you go above it to make it cash flow or?
Well, we're gonna be 1.3, 1.4 on most of our deals. And our leverage is pretty low, relatively speaking. So again, this kind of comes back to market cycle. So 5 years ago, I would have been more comfortable doing 80%. Now I'm closer to 70, just because as that thing just keeps chugging along, I'm pulling back. Because at some point it's gonna level off and it may go down, I don't know, but you know, I need to have some fudge factor in.
I'm doing the same thing with all my pro forma. My investors, just on townhomes and fourplexes, they're like, why do you have such a large down payment? Because I don't want you to get caught. You know, I want
We need to
be
make the numbers
conservative.
work too, right?
And that too, yeah.
Yeah, it makes it more
Cap
difficult.
rates are getting suppressed,
So
you
you don't
gotta
wanna
put
say,
more
well,
down.
you have to put $1,000 a month in here to cover, you know,
Mhm.
because you only wanna come in with 20 or 30%, it's gonna cost you 1 or 2 grand a month, you know,
Yeah.
in negative, so.
Yeah, we try not to be negative. Luckily, in my markets, you can still be pretty positive. We're looking at high five caps for brand new properties, which is nice. Question?
I'd love to think that this is why you're here, but why are you in the Bay Area? You guys have like a fundraising event this week?
Well, for us, we're constantly trying to build that network,
Right.
both from, I mean, if it's in an area where we're looking to buy properties, then obviously we're building a network from finding opportunities. And then elsewhere, we're always trying to find people that are interested in investing. It's really, I mean, this business is 2 things. It's deals and money. And if you don't have enough of one, the business shuts down. So you gotta have deals, you gotta have money. So you're constantly looking for deals, you're constantly looking for people that want to invest with you. So yes, I mean, that's a big part of what I do is spend time talking with people, telling our story, building trust, getting them to say, hey, great, this sounds good, let's do it. Because without them, I don't have a job. So.
No, any chance I get to come out here, I have a huge amount of my clients are in the Bay Area and in Southern California because they'll sell at a 2, 3, 4 cap and buy in Utah and Boise with me. Love hanging out with Grace. Her and I are good friends, and I have probably 5 other clients and large-scale investors that I meet with. And I try to come out here a couple times a year.
Got it.
Yeah, this is I mean, if you think about it from a cost-benefit standpoint, markets like California, New York, Boston, those areas where the prices are so high, they're a great place to go and say, hey guys, look, you can take your 3% money and triple it with what we're doing.
Yep.
So it's an easier sell than if I go to somebody in Ohio and they're like, well, I'm already getting 10%, why do I need to go with you?
Even a 1% jump in cap rate is massive when we're talking investments. You just 1%, and you can get a 1 to 2 to 3% going from California to Utah, Idaho. Teresa, right?
Yes. I love the due diligence that put into making sure we find the right deal and a good deal. Life is unpredictable sometimes.
Yep.
Have you ever find yourself ended up, unfortunately, in a position where a good deals ended up not as good as you thought?
Absolutely, absolutely. And that's why we have fudge factor in our deals. So that no matter what happens, we're gonna come out okay.
So
I mean,
No matter
obviously if the world ends, okay, that's true, but
But for example, we stress test. If you're talking to someone and they don't stress test or know what a stress test is, that's really important. So does anybody know like what the average vacancy was for multifamily in the downturn? Guesses? Anybody?
Average vacancy?
George,
20%.
calling on you.
20?
I think you're cheating. I think I already told you about our stress test.
No, I'm just
So it was like 8 to 12% for like really properties that got hit hard. In Utah, we were like 3 to 4, and a lot of multifamily didn't even get affected in the downturn. So in Boise it was 7%. I know I went back and I looked and I did that research. So we're not gonna buy a property unless it covers its expenses at 20% vacant. Typically, that's a, you know, Robert, you can talk more about that, but that's kind of a deal that we're looking at, and we don't want something that is only covering its expenses if it's 5% vacant. That's not the type of deal
This
we're
one
looking
was
for.
3%, but I put 10% on that.
Mhm.
Yeah.
But going back to what you're saying with regard to CapEx or deferred maintenance, I think, again, that kind of comes back to that deal I was telling you about that my buddies made an offer on and I did. So I had a $7,000 per door budget for what I thought needed to go into that property. They were half of that, $3,500. Now, they could get it done for $3,500, but it left a ton of deferred maintenance in that property. I was gonna go in and catch it up so that it was a well-run, quality asset at the end of the day. Now, I was also gonna hold that for 5 to 10 years. They were thinking, we're gonna go in 2 years, flip it, we're out of here, the next guy's problem. So, okay, yeah.
It's a different mindset.
Then they're not wrong.
Different model.
But they're wrong if they can't sell in 2 years.
Well, exactly, that's
market changes.
The risk is, yes, if that business plan doesn't include some sort of factor of the economy taking a correction sometime, you're gonna get caught, so, yeah.
You don't want to do what's called a capital call. I don't want to call George and say, hey, I didn't raise enough money. We've got to fix stuff. We don't have enough. So can you send me some more, please?
Mm.
That's really uncomfortable.
I
That's
actually
what
just
we're,
got one of those guns.
yeah,
What?
Linden's invested in
It wasn't real estate, it was software.
Oh,
It's a
okay.
software company.
Software.
But the CEO got fired, right?
I fired the CEO.
CEO got fired.
That's not
He
good.
was
Well,
paying-
yeah.
So, anyways, great question. Anything else?
The only thing that, you know, when you go outside this market here and you look at 7 caps, that's great, all well and good, but in the downturn, aren't those tertiary markets and those kinds of markets, don't they get hit the hardest?
The
Versus the
markets,
safe Bay Area as a comparison?
the markets that got hit the hardest are A-class luxury, the really expensive stuff, and your D-class, your blue collar but really low end blue collar. So yes, the markets are important. We follow jobs. So if there's not job growth, if there's not a stable job like Utah, Boise, massive job growth, huge job growth, you're not gonna have an issue there. But yeah, you go to Peru, Indiana, or wherever this other location is, yeah, you have no job growth. It's a one-horse town. We stay way away from one-horse towns because you're right, that's high risk. I haven't seen a 7 cap in like years, I don't know. We can force it to be a 7 cap by rehabbing, but yeah, I mean, I've told Grace and my other investors, like, yeah, you can buy a 4-plex in Utah at a 6 cap. That's not as sexy as a 7 cap, but your risk is low. You have massive job growth and stability. You don't have that in St. Louis where you're buying a 7 cap, but there's not the stability in the job growth. So the answer to your question is job growth is massive, job diversity, the type of jobs. If it's all construction, for example, like St. George, Utah, where he's staying right now with his in-laws, massive growth, people are building, I have friends buying there. But look at the economy. It's people that are in construction or people that are servicing all the people that are there for fun, all the second homes.
Retirement.
Phoenix, why did Phoenix get trashed in the last market? It's all second homes and it was construction. Why did Southern Florida or Florida get hit? Because it's second homes. So look at the job market. If it's all construction and entertainment, then yeah, that's probably not a good market to be in. And we're not really looking at those markets.
I just want to add to what you're saying. So what we do is we go back and look at a 30-year unemployment history for every, we do it by the zip code, by the city, and the MSA to get a pretty good feel. And that's really the main thing. I mean, jobs drive multifamily. That's, that. So that's the big thing that I look at. I want to look at things like, how bad did it get in the last major crash? How fast did it get there? How fast did it recover? Was it outpacing the state the national level. Those are all things that to me are really important, because back to what you're saying, absolutely, that's a big deal. We're doing a deal right now that's in Shreveport, not a strong market. And that's not a market where I would go into it with my normal model. The only reason we're doing that is actually, ironically enough, what you were talking about. We got that project at a $22,000 a door discount because the guy had just mismanaged it. So there's massive upside, massive work, but it's in a stable market. So it's not gonna go crazy, but it also doesn't come down. So if I had gone in there and said, oh, you know, I need to bump my rents 10% every year to make this deal work, well, I'm out of my mind. I think that's actually how the guy got in trouble. Funny enough, he was a California investor. So I think he kind of took his model and he's like, oh, I'm just gonna put it in Shreveport. Totally, I mean, just totally different. So there are places where that can work, but to your point, if you're gonna buy a stabilized asset and you're expecting certain things to happen, yeah, you have to know what that employment history has done, I think.
Yeah.
That's how I get a comfort level around kind of saying, okay, you know, what did it do? How did it perform? Where's it going? And the other thing that I look at with regard to jobs is intellectual capital. That's like my big thing. If there's an intellectual capital driver in that town, I feel pretty good that it's going to do better than average in a recession. And that's just my personal opinion, because I think that technology, anything related to technology and intellectual capital is going to continue to be sort of the driver of our economy going forward. And so I want to be in a place where those jobs and that whatever you want to call it, that intellectual capital is there. Because I think, I don't know, I could be wrong, but I feel like that's a key component. And if it's not there, then I'm concerned. Which kind of goes back to what Sam was saying. If it's just tourism, that's not intellectual capital. I mean, Florida is famous for that. And that's why some of the markets in Florida, I can't invest in because there's just nothing there. So,
yeah. That's why we love Boise and Salt Lake City. Salt Lake City is the Silicon Slopes, Adobe, Amazon, Oracle. I mean, George has a fourplex that's literally 10 minutes from 60,000 new tech jobs in the last 5 years. Boise's similar. Micron's adding a $200 million campus. So, yeah, we're chasing jobs. We're not chasing cap rates, which is what I criticize a lot of my fellow investor specialists and realtors on is stop telling these people to chase cap rates.
Yeah.
It's a 7 cap because it's a market that's taken this long
right.
to recover from the last recession. They're still in a recovery mode and that's why they can offer a 7-8 cap. So, cool. Thanks, guys.
Yeah, thanks for your time.
Thank you.
Appreciate it.
We're going across the street, right, to BJ. So if anyone wants to join us, we're going to be across the street at BJ's, and if you have questions, you can.
Quick, because Robert's getting his business cards. My podcast launches at the end of the month. I'd love to have you guys listen, give me a 5-star review, and ask questions. We have a lot of heavy hitters. Robert